So for those of you who just joined, this is Marguerite from the Lender Solutions marketing team, and I'm happy to introduce Isabelle Helms, Cox Automotive's Vice President of Market Intelligence, and Jonathan Smoke, our Chief Economist. Their two teams stay on top of economic and market movement. They monitor trends and key performance indicators, and they keep a finger on the pulse of dealer and consumer sentiment. And their latest findings are organized today into 10 key takeaways we see moving auto retail forward. And Isabelle and Jonathan will be taking turns sharing them with you today. So just a few more things to mention before I turn it over to them. We welcome questions, so please do not be shy. Type them into the questions panel and we'll cover as many as we can at the end of the presentation. And if we run out of time, we will answer those questions by email, so don't worry about that. Lastly, we do have a few PDF takeaways for you. You'll see them in the handout section of the GoToMeeting panel. And last but not least, please take our very, very short 4-question survey at the close of the webinar, because your feedback is very, very important to us. And again, thank you. With that, I'm going to turn things over to Isabelle to get started.
Well, thank you, Marguerite, and welcome everyone. Listen, we have a lot to get through today, so I say let's just jump right in with our first key takeaway, which of course takes a look into how COVID has changed life as we all knew it. So let's dive right in, Marguerite. You know, to say that COVID-19 has uprooted the lives of people across the world, of course, is an understatement, right? Many of us are living in what is now commonly referred to as the new normal. And like it or not, I think this phrase is sticking. And so while it's impossible today to predict when life will return to the way that it was before COVID-19, 6 in 10 consumers tell us they are not ready to resume normal activities for at least 6 more months or possibly even later. So that's today. You know, one example of this new normal is the start of the school year. And so for most, I would venture to say, going back to school looks very, very different, with 80% of children doing either full-time or part-time virtual learning, which is crazy. You know, just yesterday, New York City announced plans to shut down schools because the city reached 3% positivity rate on COVID tests across the city. Now, it's important to understand that in New York City, only 300,000 of the million or so students were going to school in person to begin with. I mean, this still has a tremendous impact. And not only that, but about 60,000 students still don't have a device to do online schooling. So imagine what parents must have to live with. Obviously, this reality of kids being in the home has had a huge impact and ramifications for parents, with about 40% claiming that that by having children at home during the day, this would impact their employment situation in some way. Now, speaking of employment, you know, so far throughout this pandemic, nearly 60% of Americans have told us that they have faced some type of employment disruption, with most reporting reduced work hours, temporary shutdowns, layoffs, reduced salaries, furloughs. I mean, you name it. Very, very few have been unaffected financially by this pandemic so far. Now, for Americans who have remained employed, how they work has changed pretty dramatically as well. You know, what this chart demonstrates is the physical work location of white-collar workers before, during, and after the pandemic. So while only 9% of white-collar employees reportedly worked from home on a full-time basis before COVID, 35% are now claiming to do so. And when we think about a post-pandemic world, which is the third column on your right, it's clear that people desire a more flexible work situation with a balance of in-home and outside the home work week once this pandemic is behind us. Listen, we've looked at external research, and here's what we learned. According to Hanley Wood, 60% of people who are currently working from home, and that's many of us, they would prefer to continue working from home once the pandemic is over. That's 60%. And listen, corporate America is paying attention. According to Gartner, about 3/4 of CFOs are planning to increase the number of permanent remote employees within their own organizations as a means to cut costs. So a lot of this change is here to stay. Now, faced with so many challenges, about a third of Americans already have or expect a major life change as a result of COVID, including things like changing jobs, a move to a less populated area, or changing where their children go to school. I mean, I've heard of neighbors pulling their kids out of public school so that they can ensure that their kids are going to school physically. So it's pretty crazy. Also looking at Hanley Wood in another survey, about 1 in 3 employees would consider moving to a new home if they were allowed a permanent remote work situation. And at Facebook, who's headquartered in California, 3/4 of employees expressed some interest in moving to a different city if they could work remotely on a full-time basis. So from an implications perspective, think about how all of this disruption could affect city centers, suburban markets, and of course, the transportation mode that supports it all. So that's it for the first key takeaway. Jonathan, I'm tossing it your way.
Well, thanks, Isabel. That new normal, while we deal with COVID, leaves us with an 80% economy. So this is trend number 2. Isabel covered what the new normal means as we deal with COVID, but what that implies is really something that's depressing the economy. We saw a 5% annualized decline in the economy in the first quarter, and then a whopping decline of 31% in the second quarter, then an incredible 33% jump in the third quarter. Now look at what that makes history look like relative to what we've gone through this year. It seems that virtually every quarter prior to this year is inconsequential to what we've experienced. But really the key question is, where do we go from here? And 2 clear paths have emerged. We're going to have growth, or we're going to see a setback in the near to middle term and a double dip. The odds favor growth, and especially for next year, but much depends on the virus and the path to herd immunity from vaccines. We will struggle to get back to prior levels of activity because the virus limits activity, and that's especially true for sectors like travel and hospitality and many services. I believe we won't see business as usual until we see risk greatly diminished by vaccinations and or herd immunity being achieved some other way. And one way to see this is what we have in the Back to Normal Index created by Moody's Analytics and CNN Business, which is shown on the next slide. It is a solid indicator of the progress of the economy. The index leverages high-frequency data to measure key components of the economy that are consumer-driven, like dining out, mobility, real estate activity, retail sales of all different varieties. And the index had shown a strong recovery trend from the bottom in mid-April, but the improvement really slowed as the summer progressed, and as it approached 80 in late August, it became very difficult for us to get much higher. It declined election week fairly substantially, but recovered some of that loss last week. The index continues to indicate that the economy is nearly 20% below its pre-pandemic level of activity and unable to improve much more. And then when we look at unemployment on the next slide, the consumer represents about 70% of the US economy. So unemployment becomes a critical gauge to assess the foundation for the recovery. And this is a good news, bad news story now, because we've seen more than half of the 22 million jobs lost recovered, and that's great. But the pace of recovery has slowed dramatically, and the job losses now are more permanent as opposed to temporary. We have more than 20 million on some form of benefit, including pandemic unemployment assistance. The recovery has slowed down over the last 4 months especially, and meanwhile, the weekly new jobless claims remain very high, and actually in the last week of data are increasing. And that's an indication that job losses are still happening as the economy is unable to see recovery in many sectors. So now back to Isabelle for the next trend.
Thanks, Jonathan. As we look deeper into unemployment, it's likely no surprise to anyone that the segment that's been most impacted by this pandemic consists of households whose income fall below the 35,000 mark. So let's take a look at that. Earlier I shared with you that 58% of Americans have experienced some type of employment disruption since the start of the pandemic. And when you look at the data across household income levels, it's clear that the impact has been more pronounced among this lower income group. Although granted, the numbers are pretty staggering across the board, regardless of your income level, if you ask me. Now, it's also clear that when times get tough, lower income households don't have the same ability to work from home as high income households. You know, the numbers that you see here in green represent the percentage point increase of people that started working remotely, at least part-time, after COVID started. So it's pretty clear that the group that benefited from that the most are incomes of 75,000 K on up. Now, I listened to a podcast this morning and I thought some of these stats, this particular stat was particularly interesting given today's conversation. You know, of those that are currently unemployed, so this is the 10 million or so that Jonathan was referencing, about 90% previously held a job in the service sector. So think restaurants, hotels, entertainment, so on. You know, this group tends to skew female, Black, Hispanic, as well as lower income. And so when you think of jobs in the service industry, rarely can those be conducted at home. And so clearly the inability to work remotely has created a challenge for this group to sustain an income, particularly during the shelter at home mandate period that we experienced earlier this year and what may be coming as a result of the second wave of the pandemic. So as a result, lower income households have been more likely to have missed a bill since COVID started. Here you're looking at 57% versus 24% for high income households. And on the next slide, as we take a closer look, it's clear that the bills that tend to get deprioritized include things like your utility bills, your credit card debt, auto insurance, as well as mortgage and rent. When we look at vehicle bills specifically, 13% of this group, this 35K group, reportedly pushed out at least one payment, which is more than double what we see with high-income household who reported just 6% versus the 13 that we're showing here at number 5. And when we talk to consumers about the potential of this pandemic lasting another year, which we're all crossing our fingers and toes, but who knows? And of course, what impact that might have on their financial situation, it's clear here again that the hardship will be far, far more pronounced in households with less than 75K income. I mean, look at that. We're looking at a 20-point spread here. So as a result, of course, the dependency on a second round of stimulus is much greater among this group, and most plan to allocate those funds, if we receive them, to cover things like mortgage, rent, utilities, and basic household needs. So that wraps up key takeaway number 3. Jonathan, back to you.
And thank you. And that dependency on stimulus is leading us right into my most negative trend, and that is the expectation that credit will deteriorate. When we look at income and spending data, we start to get a clue as to why conditions have actually been favorable from a credit performance and consumer spending and this incredible recovery we've had so far. Because our situation today could have been much worse if the US government had not acted quickly to help support consumers and businesses. We had unprecedented levels of fiscal stimulus and monetary action that took place, especially back in the early stages in March and April. So incomes went up instead of falling when unemployment was at its peak, thanks specifically to the CARES Act payments and enhanced unemployment benefits. At the same time, consumers couldn't spend, so savings shot up. And if you think the stimulus and enhanced unemployment payments were too small to make a difference, think about this. Deposits and savings accounts at commercial banks in the US grew by $1.6 trillion between the end of February and mid-July. But then the enhanced unemployment benefits expired in July. The CARES Act payments were mainly received in April and May. So the economy is no longer supported like it had been. Additional stimulus is needed, but so far Congress has failed to literally get its act together. What happened in August and September as stimulus faded? Well, in August, incomes fell and spending growth slowed. It's very likely when we get data for October, it's going to reflect what we just got this week with retail sales, that spending is falling even further. And it's an indication that the financial condition of households will get worse with so many unemployed. If we go on the next slide, we can see what's happened with auto loan performance. And there, it's been a good news story until recently. Consumers used that extra money to pay down debts. Consumers also benefited from loan forbearances in all types of credit and in auto accommodations that have led to declining delinquency rates across all loan types. As shown here, Auto loan severe delinquency rates declined every month since January, February through August. But the decline was helped by accommodations, which reached 8% at the peak at the end of June. Accommodations were down by more than half by the end of September and declined again modestly in October. Loan performance would have been worse without those accommodations, and it is getting worse before it gets better, with stimulus waning and accommodations starting to end. Delinquencies did rise in September and again in October, leading to upticks in the severe delinquency rate. But when you compare today's rate versus what it was pre-pandemic or even against last year, we still see really low delinquency rates, which is incredibly abnormal for what takes place during a recession. As we go to the next slide, we get an indication that it's also been a good news, bad news story as it relates to rates. Consumers have seen lower rates as the months have progressed, but the consumers have not seen all of the declines that have happened in the Treasury market or by what the Fed has done with rate policy. So the good news, bad news story is, as a consumer, you are seeing better rates, but behind the scenes, the rate spreads have widened, reflecting that lenders perceive risk to be higher and have been pricing according to that. So the good news there is that we are compensating for and preparing for further deterioration in credit. The bad news is that consumers, and especially those with lower credit, aren't necessarily seeing the kind of rates that could really motivate purchase. The rates that you see vary by loan type. So for example, mortgages have seen a much bigger decline in rates on average. And within the auto market, it depends on the borrower and the type of purchase. So on new vehicle financing, a consumer with a FICO score of 760 or higher is seeing much better rate movement than a consumer that's subprime. So it all depends on who you are in the market. And naturally, that then leads us to that subprime has actually declined, as shown on the next slide. Those lower credit tier consumers are not getting the 0% deals that were much more significant, especially earlier this year. And so it's created an environment, when you look at the terms as well, that are frankly just not appealing for subprime consumers. And one of the most visible ways to see that credit is tightening is to look at the share of subprime in the new market, which is what's shown here. And it's down dramatically and not staging much of a recovery as of late. On the next slide, I'm showing you something that we just launched this week. It's a new vehicle affordability index that we've done in partnership with Moody's Analytics. It reflects how many weeks it takes for the median household to afford the average new vehicle, given prices, rates, terms, and incentives. We saw affordability improve in April, but since then it has deteriorated rapidly, since as prices paid have hit all-time highs, incentives have actually fallen, incomes are falling because of the waning fiscal support, and terms have not become more generous. If you want more information on the index and what's behind it, it's one of the downloads that we have available for you in the handouts today. So with that, back to you, Isabelle.
Thanks, Jonathan. I think as we dive into the next section, we've been getting lots of questions about how dealers have fared through this pandemic today, to date. And I'm afraid that the impact of and the recovery from COVID really is not uniform across dealers. So let's dive right in. Here's a look at dealers' view of the market shown as an index. And so the higher the number on a 100-point scale, the stronger the view of the market. So as you can tell, independent dealers have consistently trailed franchise dealers on their view and optimism of the market. And this is long before COVID even started. In second quarter, both groups' view of the market plunged, as we would expect, with independents plunging more deeply than franchise dealers. And while 3Q looked more favorable for both groups, their two independent dealers continued to trail franchise dealers by 15 points. Now, Jonathan will have these net metrics updated within the next few weeks, and so, or next month rather, and so it'll be very interesting to see which direction these numbers take given all that's taken place since the third quarter. When we look at the pandemic's impact on vehicle sales and fixed ops, here again, you see that independent dealers have consistently reported higher declines to vehicle sales as well as service appointments than their franchise dealer counterparts. And most recently, franchise dealers have reported 24% year-over-year sales decline versus 43% declines among independent dealers. And of course, the same story holds true on the fixed ops side, although the gap between franchise and independent dealers seems to be shrinking for the first time since this all even started. Now, given this disparity, especially on the vehicle sales side, dealer concerns about permanently closing stores have been significantly higher for independent dealers throughout the course of the pandemic. And when we look at a subset of this independent dealer group here that you see at 35%, particularly the smaller independent groups, over half today still report real concerns about needing to permanently close their doors versus just that 16% for franchise dealers. So the struggle is real. As a result, staff reductions have been more pronounced with independent dealers, where the majority of the impacts have come in the form of layoffs versus furloughs for franchise dealers, if you look on the right-hand side of your page. And at the height of the pandemic, the average independent dealers reduced their staff by 63% year over year versus just 50% for franchise dealers. While things are improving and continue to improve in recent months, the disparity between the groups remains fairly significant. Now, as we look to the future and dealers consider the market outlook for the next 3 months, the majority of franchise dealers have a favorable outlook versus independents who just tend to be more pessimistic. And so clearly this gap suggests that the optimism that is felt by franchises is not echoed by independent dealers. And of course, the question on everyone's mind is how many of the independent dealers will survive and how will that disrupt the dealer landscape moving forward? And so we're all keeping a very, very close eye on that. Jonathan, back to you.
All right. Well, number 6 is like the old real estate adage, location matters. Like the disparate impact on dealers that Isabelle just covered, we do see variation and likely more to come in how markets are being impacted. So why is that the case? Well, starting first and foremost, it's COVID. And COVID has not hit every area of the country similarly. But in this third wave, we are seeing more of the country being impacted. Daily new cases, unfortunately, continue to rise and hit new records. We had more than 187,000 last Friday, and we are on pace to hit 200,000, if not today, then probably tomorrow or Saturday. The growth is occurring across the country, whereas the first 2 waves really hit certain regions of the country. But even still, when we do our assessment and we update a view of the country every day using data about cases, fatalities, as well as now hospital capacity. And unfortunately, what we're seeing in that really causes some challenges in parts of the country because our analysis indicates that intensive care unit capacity in 44% of the counties in the country are beyond what they can handle. So they're having to go to extraordinary measures to handle surge capacity. And those are the bright red counties on the states. We have a record number of those counties. They do tend to be concentrated more in the Midwest, the upper Midwest, and the Plains states. But since those continue to rise, it will definitely have an impact on where restrictions are happening and how more of this winter is going to play out. And then another area that we've been tracking all along in terms of the different impact is with unemployment. So the next slide is showing you unemployment claims. And unfortunately, over the last 2 months, it's become more difficult to assess straight up from just one metric. And that's because traditional claims from most states are limited to at most 6 months of coverage. So the map on the left is what I originally was simply using as we navigated the year. But now I'm having to use 2 different maps. So the map on the left is using the traditional state unemployment benefits, which were down to 6.8 million, but they're limited to at most 6 months of coverage. Instead, we've got 20.3 million on some form of unemployment benefits, including pandemic unemployment assistance, which provides coverage beyond 6 months as part of the CARES Act. But guess what? That coverage is set to expire the last week of December. So looking at the maps as a percentage of February's jobs, those traditional claims really highlight states that are heavy in travel dependency. So California, Hawaii, New Mexico, Nevada are the hardest hit states. And then though we look at those pandemic unemployment assistance on the map on the right, we see states that were initially impacted as well as a few of those states. So we see New York, Massachusetts, and Pennsylvania added to the group more significantly impacted. Initial claims also unfortunately increased in the last week to 742,000, which is very high by historical standards and moving in the wrong direction. So this situation is going to really be relevant to understand how different markets perform. And likewise, the next slide shows you consumer sentiment. We've been using the index of consumer sentiment from Morning Consult throughout this pandemic. It is now down more than 20% from where we were pre-pandemic, and it's really declined significantly since the election. And this week, we're still tracking down even more. When we look at how it's played out by the largest DMAs, which are what's shown on these two maps, the maps are getting worse looking as well. The map on the left shows the change since February, and no market currently has higher consumer sentiment than where they were in February. 13 markets, the yellow ones on the left, are now down less than 15%. 100, the vast majority in that shade of orange, is between 15 and 30%. And 29 have seen a more severe decline. Those are the ones that are in red. The map has no green, more yellow, and more red than we have been seeing. The map on the right shows the change in the last week, and because we're seeing sentiment come down nationally, that relates to the likelihood that we are and indeed are seeing more losers than gainers. So we had 78 markets declining last week. Those are the ones in red. 50 were up. Those were the ones in green, and 14 were unchanged. What's behind these different movements are politics. So areas, they're more happy about the election result versus those that aren't, but also COVID-19 is playing a role. And then when we look at the automotive market, we're definitely seeing market differences too. So the next slide also shows you two maps. In the early stages of the recovery, we saw tremendous wide variation in markets, and they were related to the restrictions and lockdowns. The heat map on the left is showing you what the estimated sales were using unique credit applications on DealerTrack for the week ending April 5th compared to the same week a year ago in 2019. So back on April 5th, we had no up markets. There were 39 red severely impacted markets. Those markets were down 95% year over year. Then when we compare that to the map on the right, we had no severely impacted markets last week. So at least we had no map no red on the map. And week over week, the map was better last week than the week prior, election week. We saw actually more pain. But those yellow markets were down on average 5% year over year last week. The green ones were down 5% and the yellow ones were down 20%. So we've definitely seen a weakening from what we had earlier in the year. And I believe this is especially going to be the case with this rise of cases and the restrictions that are already starting to follow. So expect more variation by market. Back to you, Isabelle.
Thanks, Jonathan. Well, I hope this next section lifts up the mood a little bit. As much disparity as we seem to be seeing across the country, Jonathan, I think one area where we do see uniformity is the degree to which dealers are embracing online shopping. So let's dive right in. For years, consumers, and we know this, have had a desire to complete more of the car buying process online, right? Removing much of the hassle and the friction of visiting the dealership in person. This year in particular, we're now at a point where 9 in 10 car shoppers tell us they want to do more online, including steps that have been traditionally done at the dealership. So things like trading in your offer or your car, negotiating your deal, signing the paperwork, and so on. We are seeing signs that consumers want to do this online. So in response, 3/4 of franchise dealers have now embraced digital retailing, whether those are cobbled together in-house solutions or software purchased from a provider. And many have held on to these solutions ever since the start of the pandemic. At the same time, consumers who have had a taste of this new approach to car buying, well, they tell us they really like what they see. So in fact, some of the numbers that are on this page, will point to the fact that 7 in 10 recent online car buyers told us that their most recent car buying experience was much or somewhat better than last time. So that's a big number. But consumers aren't the only ones realizing the benefits of digital retailing. Dealers see a lot of upside as well, with 78% suggesting that digital retailing has created efficiencies inside their stores, including things like reduced time spent on the sale, improved consumer experience, expanded market share, more qualified leads, and so on. And when speaking with dealers about their plans post-COVID, 3/4 of those that are continuing, of those that currently have a DR solution, plan to continue to offer DR, not only because it provides a better experience for the consumer, but also because it creates efficiencies within their stores. Now, look into the future. 84% of franchise dealers believe that customers will continue to complete increasingly more steps of the buying process online. In fact, by 2025, they believe that 4 in 10 consumers will buy a car entirely online. We're not far away from that. Fast forward about 10 years, and these same dealers expect that number to climb to nearly 6 in 10. Dealers are taking appropriate steps to prepare, but they have a ways to go. In fact, only 30% of dealers that we talk to today feel that their staff has been successful in embracing DR. And to drive adoption, the majority of dealers have had to adjust their staff's sales incentives. The most successful dealers have done a number of things, including adapting their communication strategy from trying to attract leads by driving the conversation towards a sale to driving the conversation towards a dealership appointment. So it's really changing the conversation that takes place between a salesperson and a consumer. Key to this success is also making sure that you have the right staff. And so moving forward, about half of franchise dealers plan to more heavily invest in talent that's digitally savvy and equipped to complete a sale entirely online. So lots of changes taking place within the walls of dealerships today, and certainly more to come. Jonathan, back to you.
It's been impressive to see what dealers have done, and they've been remarkably innovative. But one challenge has emerged like no other, and that brings us to trend number 8, inventory is lacking. So it's in part of the data that Isabelle already shared on dealer sentiment. A question that we always ask is, what factor is holding your business back? And one challenge emerged to be like no other, inventory. The latest survey in the third quarter, and as Isabelle shared, we'll be publishing the fourth quarter results in just a few weeks. Dealers identified inventory as the #1 issue holding their business back. Franchises see new inventory declining and at clear lows for our survey history back to 2017. Franchises have a similar view of used, with independents seeing inventory declining even more. In terms of factors holding back business, the majority of dealers say inventory is the biggest enemy, worse than COVID-19 or the economy. And as we go to the next slide and see what that's like in the new vehicle market, you can clearly see that the strong recovery combined with limited new production in April and May and a hobbled supply chain coming out of that is leaving the industry with the lowest inventory levels in almost 9 years. We estimate that we lost about 3.5 million units. The good news is in the last few weeks, the last 6 weeks specifically, we're starting to see inventories come up, and that confirms that production is surpassing the pace of sales and starting to allow supply to build. But inventory is down 24% year over year, and we will continue to be in a supply challenged market for likely most of the next year. When we turn to the used vehicle market on the next slide, we see that it was in a better position than new initially, and that was true for many months, feeding the strong recovery we had in the used vehicle market. However, as the recovery heated up, that supply quickly changed to normal, and retail supply actually fell below normal for many weeks this summer. Used supply has increased modestly in recent weeks and is now slightly above normal level supply at 47 days. And wholesale supply is also now relatively normal at 25 days. So, but part of that normalization is the fact that sales have modestly come down. Actual inventory levels remain down year over year for both retail and wholesale. And if you're interested in a bit more detail there, as well as what's happening with vehicle prices as a result, one of the other handouts that we included today is the Manheim Index report for mid-November that we just published earlier this week. Back to Isabelle.
Thanks, Jonathan. So our next trend is taking a look at the impact of COVID on consumer mobility. And I'll tell you, there's good news on the horizon, especially when we talk about the future of traditional vehicle ownership. So many forms of transportation were severely impacted by the pandemic, as the slide here illustrates. Services such as ride sharing, public transportation, and taxis, all those took a severe hit. And while some progress is being made, it's clear that consumers are still reluctant to share a ride. So one form of transportation, however, that remained relatively unscathed is the personal vehicle, which 9 in 10 consumers consistently relied upon throughout the pandemic. So yet, while the personal vehicle has remained the preferred mode of transportation for consumers, we know that the average household is driving far less than they were pre-pandemic. You know, at the height of COVID, the percentage of Americans fueling their vehicle at least once a week dropped by over half to 21%. Today, consumers are slowly starting to drive more, but we're still pretty far from reaching the 55% of consumers that once fueled their car at least once per week. You know, the question this all leaves us with is how this pandemic will impact vehicle transportation long-term, especially traditional vehicle ownership. You know, I'm here to say that for now, only 15% of consumers expect to continue to drive fewer miles in a post-pandemic world. So this is good news for the automotive industry. For now, uncertainty about the economy, unemployment, government relief, I mean, all the things we've talked about today, those are really impacting consumers' desire to buy a car. And so over the last 6 months, we've seen this steady decline in the number of consumers who said they plan to buy a car in the next 6 months, with, of course, concerns about their financial stability being the top reason why consumers are deciding to delay their next vehicle purchase. But something interesting surfaced this past weekend. We were out there surveying consumers, and reversing this 6-month trend, we are seeing encouraging data with about 20% of consumers saying they plan to buy a vehicle sometime in the next 6 months. And so as we look ahead, this places us on the path to a new administration, hopefully additional government incentives and tax returns. We also know that consumers have been saving money, right? They're sitting on about $1.8 trillion of extra money that wasn't here in February. And so this may also explain why we're noticing this uptick in intent to purchase, which we are seeing on Autotrader.com, whose consumer traffic has been steadily increasing within the last week, as well as dealer track credit app volume. So we're hoping this is a bit of positive news here. Now, when we look longer term, the news is equally good. You know, while 17% of consumers tell us they plan to own fewer vehicles in a post-pandemic world, a larger percentage plans to offset that figure by increasing the number of vehicles in their household. So we're happy about that. So, you know, while at times it may be difficult for all of us to see the light at the end of the tunnel, I think it's safe to say that the future of automotive isn't so dim after all, if we all believe these numbers. Jonathan, back to you to wrap us up.
Well, Isabelle, I believe them, and that brings us to the last trend and the most positive, and that is the worst is behind us. I know that seems crazy with the news lately, especially about COVID, but I do believe that even though we may have a few setbacks this winter, we won't see anything like we went through last March and April. And that data that Isabelle just showed us on purchase intention is yet another reason to be bullish about 2021. 1.8 trillion in savings is indeed what's there and able to be spent when people feel ready to spend it. That's 10% of GDP. So it could absolutely have an impact on the economy and the auto market in a big way. So let's look at the vehicle recovery. The first slide I've got here is the V-shaped recovery that you can see, whether you're looking at it from a sales perspective or year over year. And it has been impressive. Only the housing market has been better than the auto market. The new market couldn't get close to being fully recovered without supply, as I've shared, but it is now gradually improving. The used market actually was up year over year for much of the summer, but lost momentum in the fall as supply became a challenge there too, and we saw record prices as a result. We do expect to lose some momentum in retail sales this winter, and that's already starting to play out a little bit. But this is typically the slowest time of the year, and it's not looking like we will be dealing with another complete shutdown of the economy again, quite like we experienced before. And then the next slide addresses the election and the implications from the election. So now that we know that Biden has won, and we can assume that the Congress is going to be split with the Republicans maintaining a very thin control over the Senate, we can focus our attention on the things that are most likely to happen and have the highest impact on the automotive market. So what we can plan on is that we're going to have more certainty in several areas, and we're going to be focused on the things that Biden can do without congressional support, or the ones that we're likely to get to see consensus. What matters most and is highly likely are stimulus actions, which we think will be the first priority of the administration and the Congress when it starts. The new one starts in January. We do believe that we're going to likely see something in the neighborhood of 1 to 1.5 trillion in a new stimulus package. It's going to be tailored very similarly to the CARES Act, involving enhanced unemployment benefits to address those people that are losing benefits at the end of the year and still impacted by COVID-19, and also provide cash payments, which we think will, a good portion of which will be used for vehicle purchases. The other things to call out are a mixture of positives and negatives. Increasing trade certainty is definitely a positive. We're going to remove some uncertainty, especially about possible new tariffs coming from to vehicles imported from Europe and from Japan. We'll also see less kind of spats with our partners like Canada. So the supply chain in general is going to be able to be more consistent and productive. Then as we look to the high likelihood negative factors, and you can argue different perspectives depending on who you are in the market, but we are likely to see a strong return to environmental standards similar to what the Obama administration had, if not stronger. That's going to hasten a move to electric vehicles, but it's also going to make all types of vehicles more expensive, and if we're already seeing affordability challenges, that's definitely going to be a challenge, especially in the new vehicle market, and it's going to lend itself to higher prices across the board, including the used vehicle market. And then finally, one of my biggest concerns is really financial regulation, because we are likely to see that the Consumer Financial Protection Bureau is strengthened, and it's going to be focusing on automotive, because unfortunately our timing is bad, with the delayed delinquencies and defaults this year likely to result in more defaults and repossessions next year. It'll probably attract headlines, and the CFPB will be doing things that over time will make credit more expensive or more difficult to get with more regulation. The good news is, with the split Congress, we won't likely see major moves in tax policy, which would have been likely the biggest negative for the automotive market over the medium and longer term. So I'm ending with a summary of our 21 forecast. We can get into details if people want to talk about that, but it's a continuation of a growth story, but it does vary by market segment. We are expecting another 6% growth in the new vehicle market, We don't think that we can grow much more than that because of supply constraints. Most of the production forecasts do not see us getting to 16 million in vehicles being produced that feed the United States. So that limits what our sales potentials are going to be. So guess what? That means another great year for the used vehicle market. That combined with credit continuing to be relatively tight and the threat of regulation making that tighter, we think that used is going to be fully recovered next year, and used retail and CPO are going to be the strongest parts of the market. And because of this environment of limited supply and strong demand, we think used vehicle values will continue to be strong, giving up none of the gains that they've experienced so far. So that is the end of the 10 trends.
Thank you for joining us today, and we wish you a safe, healthy, wonderful holiday. We'll keep this slide up for a while and close the webinar in about a minute. Thank you again.